Now, so step one, the contract. Now, the difference is IFRS 9, the emphasis is on legal enforceability. So under financial instruments, a contract must be legally enforceable. When it comes to IFRS 16, that is not a requirement. All right? That is not a requirement. A contract has the following requirements. Number one, collection is probable. So if there's a collection issue, you can't recognize any revenue because you don't have a contract per IFRS 16. For there to be a contract, you have to expect to get paid. Again, probable in IFRS is over 70%. Point two, the rights to the payments for the goods and services can be identified. That one's more straightforward. So the contract is clear what are the deliverables and the payment terms. The contract has to be approved. This is kind of like the old US GAAP rules. For there to be a contract, it has to be signed by both approved. Signed if that's the normal process. If it's not approved, it doesn't count. The other one, for it to be under the scope of IFRS 15, is commercial substance. So what do we mean by this? Let's say you have two companies that sell cars. So we're two dealerships. One is in the north side of Karachi and one is in the south side of Karachi. And we both sell Honda cars. Now, what happens is if someone comes into my store and they want a blue car, and I don't have a blue car, but you have a blue car, and I tell you what, I'll give you my red car, you give me your blue car to swap. So what you normally find under IFRS is that there is not commercial substance when two dealers exchange amongst themselves. Therefore, that's not part of revenue, and that's not part of IFRS 15. That would be other revenue, other expenses. It's outside the scope. So commercial substance is where the transaction is done for a commercial gain, effectively. And the most common example there is when dealers help each other out. A dealer-to-dealer exchange. Because what you expect is it to reciprocate. So that means you don't have a contract per IFRS 16. Of course, you have a contract, but out of scope. It's a contract out of scope of IFRS 15. Sorry.
So if I say it is made to a normal customer but at cost, then would that contract be out of IFRS?
Well, why would you make it to a normal customer at cost?
Just a one-off transaction, or just to make the relationships, or just to gain the future?
Well, if it's okay, two scenarios. If it's made to a genuine customer at a cheap price because you expect there to be side benefits to your business, you would say there's commercial substance. Okay. If you made the sale to, say, an owner, and you did it at cost, because he's the owner.
For example, do the employees at cost?
The employees is a more tricky question. The owner at cost would not have commercial substance because as an owner, you're able to basically manipulate. I mean, you're able to, look, I own it, don't charge me a profit. So if you sold a vehicle to an owner at cost, that would not be part of revenue. That doesn't have commercial substance. Now, if you sold it to a staff member, this is a more tricky one. Because I would say if you sold it to a staff member, part of your benefit as an employee of working at that company is to be able to buy these things at a special employee discount. And you would normally consider that to be part of your fringe benefits. Right? So even though there isn't a profit on the transaction, this is a more tricky one. The commercial substance is the fact that it's done for a commercial return because your employees hopefully will be loyal to you. So I would view that the transaction with the employee to be under the scope of IFRS 15. That's a tricky one. I'm not 100% on that one.
It can be an exam question.
No, that one's too tricky. But I'm gonna write that. That's a good question.
Basically, it's for an exchange of employee services to the organization, right?
Yeah, well, part of your salary is you get to buy stuff at a special price.
Part of retaining the employees.
Correct. But the problem is you don't allocate part of the employee's salary cost to that discount. So that's a more tough question.
While justifying the commercial substance, especially for the retailers, there is a time when they just sell it even below cost, for liquidity purposes, for example.
That's different. I think the examples, the thing is, US GAAP has more examples on this. Commercial substance is saying the transaction was never intended to be part of our normal commercial business. The transaction was when an owner buys something at cost. There was no intention ever there to be a commercial transaction. When you sell a part of your inventory to someone in the same business because you help each other out, that is not a commercial transaction.
I'm not saying that.
So the difference is when the prices go down and things go wrong, at that point in time you made the sale, it is a commercial transaction.
Yeah.
So just because you buy something and the price tanks, or in a lot of industries, in retail, you buy things and then at the end of the season you have to get rid of them, right?
Yeah.
It's still a commercial substance. It's just today with the environment I'm in, I need to sell at a loss. It doesn't mean it's not commercial.
It has a commercial.
Liquidity management, inventory management, closing, change of seasons. We got to sell the goods. It's a new season. It's nothing to do.
It has the commercial substance of avoiding a further loss, which may
Correct.
occur due to further decline in price.
I mean, commercial substance is defined in the standard where it's a change in entity-specific cash flows. And you're selling it more than what it's worth in the wholesale market to you as an entity. So entity-specific cash flows means it's getting more. You're getting more for it than, say, someone in the same line of business. So if we're in the same business, I wouldn't pay that price. I want a cheaper price. That would be no commercial substance, dealer to dealer.
Isn't that limited to the example you gave about the car, or maybe inventory management where you don't have the expertise or the infrastructure in a particular area? For example, in the case of oil and dairy products, if in case in a particular jurisdiction or region I don't have that kind of an infrastructure to sell and I get a demand and I swap inventories with another dealer. I mean, this commercial substance example should be limited to that because I remember
Correct.
there was a para in IS 18 as well to that effect.
Yeah, and there's more guidance in US GAAP on this, yes.
There is more guidance in this standard, but I think these examples are relevant and restricted to these situations.
Yeah, it's the dealer for dealer is how I look at it. But I think the example of to your owner of the company also would apply. The owner wants it for cost. Buy it from me because I'm the owner. That has no commercial substance. The employee, that's different. More messy. So now we're saying collectability is more key, right? So if there's no collectability, there's no contract. Nothing is recognized. The performance obligations. This is also a big change. So a performance obligation is simply a promise in the contract with the customer to transfer goods or services. Now, what's new is the promise doesn't have to be explicit. It could be implicit. Implicit. So, one of my friends was doing some work at a dairy place. They sold milk. And the milk guy says to my friend, hey, listen, we don't care about IFRS 15. We just sell milk. And he goes, okay. What about those refrigerators? Oh, we give those to our customers. That's marketing. There is no such thing as a free good to the customer as marketing. Those refrigerators, whether you're Coca-Cola or a dairy company, that's in the scope of IFRS 15, right? The contract is you buy milk, you get a refrigerator. You have to take part of the milk revenue, or the proceeds from the milk, and allocate it to the refrigerator, and part of it to the milk. So there's no free item. So the challenging thing in the standard is to identify the performance obligations, which could be explicit, which is easy, but they could also be implicit or verbal. I mean, what I saw is in the software industry, sometimes you'll find a situation where someone says, look, it's my end of the year, here's version 10, why don't you buy it? You sign the paper, you buy version 10. But at dinner, I told you, don't worry, I'll give you a copy of version 11 in January when it comes out. Now, the moment they said that, don't worry, I'll give you a copy of version 11, that messes up the recording, right? In the U.S. environment, we have to train our salespeople on U.S. GAAP revenue recognition because that's a violation. Because if you do that and you don't tell the accounting people, what you're doing is booking revenue when you cannot book it. Because the promise about you get version 11, the upgrade for free, is a performance obligation. So in the software, they spend a lot of time training salespeople. You know, it's called a side agreement in U.S. language. And a side agreement is a big issue. The SEC focused on that because a lot of companies are using these to push revenue in Q4. And to do that, you